Quick question. If you've got $100,000 just sitting in a savings account right now, do you know how much of that is actually disappearing every single year? Not from a market crash, not from a bad investment, from something way sneakier, inflation. And by the end of this video, you're going to know exactly how the wealthiest families in America protect themselves from it, using 3 tools that are available to literally anyone watching this. Hey, welcome back to the channel. I'm your host here at Fintelliq, and today we are breaking down one of the most important and most misunderstood topics in personal finance: how to actually protect your money from inflation in the United States. Not vague advice like diversify your portfolio. I mean the real, specific instruments that institutions and high net worth families use. We're talking about TIPS, T-bills, and hard assets like real estate and gold. Stick around till the end, because slide 7 is going to show you an actual allocation matrix, basically a cheat sheet, for exactly how much of your money should go where, depending on what kind of inflation environment we're in. Let's get into it. Let's start with the basics, because I want everyone watching, whether you're a total beginner or you already know some of this, to be on the same page. Inflation is simply the rate at which prices go up over time. Your coffee, your rent, your groceries, a little more expensive every year. That part everyone kind of knows. But here's what most people don't think about. If your money isn't growing at least as fast as prices are rising, you are losing wealth even if the number in your bank account stays exactly the same, or even goes up a little bit. That's called real loss. Versus nominal is the number on the screen. Real is what that number can actually buy you. There's a simple formula that explains this. And honestly, if you remember nothing else from this video, remember this one line: real return equals your nominal yield minus the inflation rate minus any tax drag. So let's say your savings account pays you 4% a year. Sounds decent, right? But if inflation is running at 5%, and then the government taxes that 4% you earn, you're actually losing purchasing power every single year. You're working, saving, being responsible, and still going backwards. That's the trap high net worth families are obsessed with avoiding. And it's exactly why the next 3 sections of this video matter so much. So how do serious investors fight back? Pillar 1, TIPS. They lean on 3 pillars of defense. Bonds whose value is directly tied to inflation. Pillar 2, short-term treasury bills, which barely feel interest rate swings. And pillar 3, hard assets, things like real estate, gold, and infrastructure that hold real-world value no matter what a currency is doing. We're going to go deep on each one, starting right now. Okay, pillar number 1, TIPS. And don't let the name scare you. Treasury Inflation-Protected Securities. It's actually one of the simplest ideas in this whole video, once you get it. TIPS are bonds issued by the US government, just like a normal treasury bond. Except there's one massive difference. The amount of money you're owed automatically grows whenever inflation, measured by something called the CPI, goes up. Think of it like this. Imagine you lent a friend $100, but you both agreed that if the cost of living goes up, the amount they owe you back also goes up by the same percentage. That's basically what a TIPS bond does. Except your friend is the United States government, which makes it about as safe a promise as you can get. Here's how it actually works mechanically. Every TIPS bond has something called a principal. That's the base amount you invested. As CPI, the inflation index rises, that principal amount adjusts upward automatically. And here's the clever part: your interest payments are calculated on that new, bigger, adjusted principal, not the original amount. So as inflation rises, both your principal and your interest payments go up with it. Now, what happens in the opposite scenario? What if prices actually fall? This is where TIPS Get really clever. At maturity, when the bond finally pays out, you're guaranteed to receive either the inflation-adjusted amount or your original investment, whichever one is higher. So worst case scenario, you get your money back. Best case, you got a full inflation hedge the whole time. It's genuinely a one-sided bet in your favor. But this is the part almost nobody explains clearly. There is a catch. It's called phantom income. The year that your TIPS principal adjusts upward because of inflation, the IRS treats that increase as taxable income, even though you haven't actually received that cash yet. You don't get it until the bond matures or you sell it. So you could be paying taxes on money that's still locked up. That's the phantom part. It's income you're taxed on before you ever touch it. So if phantom income is the big downside of TIPS, how do smart investors get around it? Simple. They don't hold TIPS in a normal brokerage account. They hold them inside accounts where taxes are already deferred, so that phantom income problem basically disappears. First option, a traditional IRA. Because a traditional IRA already defers taxes until you actually withdraw money in retirement, that annual phantom income headache just goes away. You're not taxed year by year. You're taxed later on your terms. Second option, a 401k plan through your employer. Same logic applies. Because it's a tax-deferred, employer-sponsored account, those yearly CPI adjustments to your TIPS principal aren't creating a surprise tax bill every April. And third, certain tax-exempt vehicles, which, depending on your specific situation, can eliminate that phantom income drag almost entirely. The big takeaway here, and this is genuinely one of the most useful, actionable tips in this entire video: TIPS are a fantastic inflation hedge, but where you hold them matters just as much as the fact that you own them. Put them in the wrong account, and taxes quietly eat into the benefit. Put them in the right account, and you get the full protection with almost none of the tax friction. Alright, pillar number 2. And this one is, in my opinion, the most underrated tool in this entire video: short duration treasury bills, or T-bills. If TIPS are the inflation fighting specialist, T-bills are the flexible, nimble teammate that can react instantly whenever the Federal Reserve changes interest rates. Here's the core idea in plain English: the shorter the amount of time until a bond pays you back, the less risk you're exposed to if interest rates move. A T-bill that matures in 4 to 13 weeks barely reacts at all to rate changes, because you'll have your money back before those changes really matter. Let's look at the spectrum. On one end, you've got 4-week to 13-week T-bills. Duration exposure here is ultra low. We're talking a fraction of a year, and price volatility is basically negligible. Their whole job is liquidity management and letting you capture higher rates fast whenever the Fed hikes. Next up, 6-month to 12-month T-bills. Slightly more duration, still very low, still minimal volatility. These are great for locking in a yield across an entire Fed policy cycle without tying up your money for years. And then, for contrast, look at 10-year nominal treasuries, the classic long bond. Duration here jumps all the way up to around 8 years, and that means serious price risk if interest rates spike. These long bonds can actually be a poor inflation hedge, even though people assume all government bonds are automatically safe. They're better suited for a totally different scenario: a deflationary recession, which is not what we're focused on protecting against today. Here's a bonus almost nobody talks about. Income from T-bills is completely exempt from state and local income taxes. If you live somewhere with high state taxes, California, New York, New Jersey, this is a genuinely big deal. It means the effective after-tax yield on a T-bill can actually beat a CD or a high-yield savings account offering a similar headline rate, simply because of how it's taxed. Now, let's talk about Pillar 3. And this is the one most people already have some intuition about, even if they've never heard the term hard assets before. Hard assets are physical, tangible things that hold real value completely independent of what any government or currency is doing. Real estate, gold, infrastructure, things you can, in some cases, literally touch. First up, real estate. Why does it fight inflation so well? Two reasons. One, rents tend to rise every year, roughly tracking inflation, sometimes even outpacing it. Two, the cost to actually build a new building also goes up with inflation, which makes your existing property more valuable simply because it would cost more to replace. The risks, though, are real. It's illiquid, meaning you can't sell it in 5 minutes like a stock. It comes with management, headaches, and refinancing gets more expensive when rates are high. Second, gold and precious metals. This is the classic, thousands of years old store of value. When people lose trust in a currency, they historically run toward gold, because gold doesn't get printed or devalued the way paper money can. The catch? Gold pays you zero yield. No dividends, no interest, nothing, and you've got real costs just to store and insure it safely. And third, infrastructure and energy assets. Think toll roads, pipelines, utility companies. A lot of these businesses have contracts that are literally legally tied to the CPI, meaning their fees go up automatically when inflation rises. That's about as direct an inflation hedge as you can get in a business. The trade-off is these projects need enormous amounts of upfront capital, and they're heavily regulated, so returns can be slow and bureaucratic. Simple explanation, the payoff slide. Okay, this is the slide I told you about at the beginning. This is the cheat sheet. Because here's the thing. Knowing about TIPS, T-bills, and hard assets is great, but the real skill is knowing how much of each to hold, depending on the economic environment you're actually in. So let's go, scenario by scenario. Scenario 1, sticky or elevated inflation. Scenario 1, sticky or elevated inflation, somewhere in that 3 to 5% range. Honestly, a pretty normal, common environment. The suggested mix here is 40% TIPS, 30% short T-bills, and 30% hard assets. The logic: TIPS are capturing that steady CPI growth directly, while your T-bills keep rolling over into new, higher rate instruments as the Fed adjusts policy. Scenario 2, stagflation. Scenario 2, and this one's the scary one, stagflation. High inflation combined with slow or stalling economic growth. This is genuinely one of the toughest environments for any investor. Here the mix flips: 40% hard assets, 40% short T-bills, and only 20% TIPS. Why the shift? Because in a slow growth environment, you want tangible, real-world value and maximum liquidity, not just paper promises, even inflation-protected ones. Scenario 3, disinflation, or Fed pivots. And Scenario 3, disinflation, or a Federal Reserve pivot, meaning inflation is finally cooling down and the Fed starts cutting rates. Here, the smart move is pivoting out of short T-bills and into medium-duration treasuries and equities, essentially locking in today's higher yields before they disappear, and re-entering growth assets as the economic picture brightens. Pause the video right here if you need to. Screenshot this slide. This is genuinely the kind of framework financial advisors charge real money to explain. Alright, so you understand the theory now? But theory doesn't protect your money. Action does. So let's turn this into 3 concrete steps you could genuinely start this week. Step 1. Step 1. Build a T-bill ladder. This just means automating a rolling series of purchases. Say, buying a new 4-week or 13-week T-bill regularly through Treasury Direct or your brokerage, so that some portion is always maturing and reinvesting at the current rate. You get that state tax-exempt yield we talked about, with essentially zero duration risk. Step 2. Step 2. If you're going to hold TIPS, put them inside a tax-deferred account, a traditional IRA or a 401k. We covered exactly why earlier. and neutralizes that phantom income tax problem almost completely. Step 3. And Step 3 maintain some core exposure to hard assets. Direct real estate holdings, or infrastructure funds that actually produce cash flow, not just speculative bets. Assets that pay you along the way, while also protecting your long-term purchasing power. 3 pillars, 3 accounts, 3 simple actions. That's genuinely the whole framework. So let's bring it all together. Inflation quietly eats away at cash and long bonds. To fight back, you balance 3 things. CPI growth through TIPS, duration risk through short T-bills, and real, tangible value through hard assets. Get that balance right for whatever environment we're in. And you're doing exactly what sophisticated, high net worth investors have been doing for decades. If this video actually helped you understand inflation protection better than before, do me a huge favor, hit that subscribe button, because we're breaking down frameworks exactly like this one every single week here at Fintelliq. Drop a comment and let me know which pillar you already use, or which one you're planning to add next. TIPS, T-bills, or hard assets. I read every single comment, and it genuinely helps me pick the next topic. And hey, quick reminder before you go. This video is for educational purposes only. It's not personalized tax, legal, or investment advice. Talk to a registered investment advisor or a CPA before making any real allocation decisions with your own money. Thanks so much for watching all the way to the end. That actually means a lot. I'll see you in the next one.